Hey guys, as promised, welcome to the first educational video brought to you by Total Control Traders, the ultimate crash course for beginner traders and those who are looking to start. Let's get right into it. Alright, so when you first start looking to trade, you pull up any chart, you're going to see something similar to this, which is just green and red candles. Sometimes it's black and white, whichever, but something along the lines of this. Actually, you might not even see the volume, so it's just a chart that looks like this. And how do you how are you supposed to read that? Well, the answer is you can't. It's just like any other job. You're gonna need tools to help you in the job to succeed. So this video is gonna teach you about what indicators might be appropriate for you, what indicators have helped me personally in the past, just to give you an idea of what's out there. And the other thing is, thank you everyone for watching my videos. We have reached 200 views, or nearing 200 views. That is extremely exciting, especially being first week, not even coming up to the end of first week of my channel. So again, thank you guys for all those who are supporting. Alright, so when you look at this chart, there are some common indicators out there that are very popular, and there are reasons why they're popular. Okay, first one we're going to talk about is Bollinger Bands. Bollinger Bands is something that measures the previous movement and going from there. It's sort of the best way to look at this is think of it as a spring. As you get compressed and compressed and compressed, it is bound to go one way or the other. So in this particular case, it went downwards, and same with this one. However, is there any in this particular case, it went upwards. Bollinger Band is one of the most commonly used indicators for long-term traders. Now, whenever it comes to indicators, there are a gazillion out there, and ultimately is more about testing, trial and error. You gotta find those ones that work for you. You can't have like 20 indicators up. I mean, you can, but it's not really gonna help you with your trading. You have to find your edge, something that works for you. Okay, the reason why I started off with Bollinger Band is it's something that, for me, when I first started trading, someone brought it to my attention, and then I sort of looked at it. I really liked how charts reacted to it, and I used it back then. Nowadays I don't really use it anymore. So again, it's finding the ones that work for you. Now let's go into a couple other indicators that are most common. I'm just gonna pull up my favorites here. So this is a list of the indicators I have personally used over the past year, 2 years kind of thing. There's MACD. That one is another extremely popular one. And there is Parabolic SAR. That one is popular as well. And I think those are the top popular. If I were to pick three, those three would be the most popular. Now, however, there are a couple that people miss to mention in their videos, in their chats. The most crucial ones. First one is volume. Regardless of what chart you look at, regardless of what stage you are in for trading, volume is your most crucial indicator that you want to have pulled up all the time. Okay, regardless of what timeline you're looking at, what time frames you're looking at, where you are, how much you're trading with, volume can tell a whole bunch of story behind it. And the main reason for that is trading is all about psychology. It's not, you see a low price, you buy in. You think a stock is cheap, you buy in, and you think the stock is expensive, you don't buy. That's actually the exact reason why people don't make money. So volume, first indicator, I always have up. Second would be the ADMA. And for some reason it's not up here. Anyways, so you go, it's called the moving average exponential. Now it doesn't have to be the 8. Most popular ones are 8, 20, 50, and 100. So depending on what time frames you're looking at, what kind of trader you are. If you're yearly trader, you probably want to be looking at 100 EMAs. Something I don't use ever. As a day trader, what I find most useful is the ADMA. And with this, it tells you where what the momentum looks like. And you can, as you can see, what I was doing is you can set it to, on this particular platform, TradingView, you can set it to however you like. Step lines, crosses. Cross is another popular one where it's just like a dot. But personally, I use a step line. So ADMA is a second indicator that you want to make sure you have up, or whether it's 8 or 20, whichever one that suits you. These two, I would say, are the most crucial indicators. And one of you have asked me a question in our trading group. What's the difference between weekly, daily, 80 or 8-hour, 4-hour ADMA? It's just based on the time frame. The way it looks at it is the last eight candles, and what is the exponential moving average from that 8 candle, and then it draws a line there, kind of thing. To go into the details, you can always Google it. It's not that complicated. You just look at the price action of the last 8 candles and the average of that. So what happens then is, as you break out upwards of an ADMA, the trend becomes bullish. Generally, you'll see a follow through. Then if we are coming back to revisit the ADMA, because we then closed under it, we only wicked off of it, this is still a strong case. And as you can see, the trend continues upwards. Okay, over the long term. So if this time frame doesn't work, you sort of look at it depending on what times if you're a long-term trader or short-term trader. The only exit signal that this chart has given potentially without looking at the volume, if you're only looking at ADMA, would be this one. Okay. Other than those two, nowadays I keep my indicators relatively simple. The other ones I sometimes use is the linear regression. This one is kind of interesting. It's still somewhat in the test phase for me. I found it to work relatively well most cases, especially if it's within the trend. So let's say, I'm not too sure what chart would make sense. Alright, let's say Apple. If you look at Apple on a clean chart, the linear regression is showing you top of trend. Even if you sold here, then you rebought at the low of the linear regression, would have made money even though it didn't go to the top. You could just hold it, then here's the top, that's where you would sell. It seemed to work fairly well over longer term trades. It's somewhat like a you could even call it a cheat code. The only thing to remember is, for example, this chart in particular, once that linear regression beginning point goes past here, and if we're still on the downtrend, it could very well start going like this instead, because now the beginning point has passed here, and it makes sense for it to start tilting down. Just something to keep in mind, something I noticed, which actually can be used as a very good leading indicator. The other thing that I use is the fibs, especially on indexes. And there's going to be another video on this, these two particularly, just in-depth review on these two tools. It's not even indicators. These are drawings tools that you can use. So I have found and used these for years now. Let's say we go back to beginning of this trend, and let's say we're looking at the 80. The SPX pandemic bounce, you got to find that top. So this is obviously the bottom. The top is here because this is a lower high. You would draw a fib here to determine potential retracement areas. This chart extremely strong. We bounce from the, can't remember the exact number, 0.236. So these levels, and when you do like a quick search on fibs, it'll tell you all the exact levels there, and there's a reason for why these levels are determined. This bounce from the 0.236, so it's extremely bullish. Then again, you do the same thing. You draw from the bottom where it bounced from to the top, and this particular one, you can see that I bounced from the 0.5. We did not close under the 0.5. Generally, for new traders, these are the most important levels to have up. And let me just pull up the levels here. The 0.236, 0.382, 0.5, 0.618, and 0.65. There is one more level after that, but generally when you reach that level, the trend is most likely to reverse already. So, and that's the 0.786. These 5 levels are the most important, and the reason why these two are so close to each other, this is called the golden pocket. Most cases we will see a bounce from here, if not from all the previous levels. This is the most crucial level to hold. Once we go past here, then the trend most likely will reverse. Okay. The other one is called a Fibonacci Extension ratio. What that does is you use it to determine where the chart is going to further run to. So for example, we bounce from bottom here, topped out here, found a higher low. Where is the next bounce going into? So you would first level, bottom, second, you could do either one, they're about the same, to the third is the higher low. And if we were to drag that across, this would have been a safe level to exit. We did bounce over it, but you can see we stalled over it, double topped, and came back. So on a safer trading style, this would have been your exit. Again, this is a different case scenario because of the pandemic. So if we were to go to closer term, let's say something like this one. We can see there's a stall in this area as well. Okay, and if we're to do the same thing, a higher low right here, too high, too low, we are coming up to just going past the 1-to-1 extension right now. So that's how you would use to determine your entry and exit. Again, nothing is ever guaranteed in the stock market, and if you get too confident in the stock market, trading in the stock market, for sure you can you know you're gonna be humbled very soon. These are just tools that help us to determine entry and exit, how to make money, and nothing's ever guaranteed. So to go back to indicator wise, there are a few other ones I use. Second one would be the Tom DeMark count. This one is I use it more so for confirmation instead of leading indicator. If everything else lines up, then I would use this as a confirmation for exits or entries. So if we were to look at this, since pandemic, easiest point to look at, there has been no number printed for the longest time, even though we were just in an uptrend for the whole time. So the way this works is, as long as the closing price of the candle is higher than the fourth candle before this, so 1, 2, 3, 4, this would have counted towards that number. So let's see, 1, 2, 3, 4. So this one would have been the 1, 2, 3, 4, 5, 6, 7. Actually, anyways, I gotta go. You can count it out, but it's extremely accurate. The one time that I printed the 9, it came back, and now we've recently just printed a 9 as well. This is just a signal. Don't use it as a leading indicator. Look at all your other indicators. Do they line up for a pullback? Another one I use, some people use this one, the Parabolic SAR. This one is under the buy and sell just because it's a multi-indicator package. So under here I only use the SAR. It's a trend identifier. However, it's good for beginners, just to help you identify where the trend is. As long as the dot, the indicator, is under the ticker, it's in an uptrend. As long as the indicator is above the candlestick, it's in a downtrend. What I found personally is it's a little bit of a lagging indicator. As you can see here, it's, even though it says that we're in a downtrend, we're actually rising back up. So I've stopped using this one. By all means, it's something that may work for you. Going back to, with indicators and tools, you just have to find your edge, something that works for you. Pivot high and low, it's nothing special, it just shows you, points out what the high and low prices are depending on what time frame you look at. And you can set it so that it tells you more prices. So let's say, I go lesser length, and it'll show me more of the higher prices. So the other one, volume profile. Now this one is kind of interesting. The way it works is it tells you how much volume, how many shares have been traded in this price range. So for example, this highest one, in between price of 291-ish to 293, is the highest volume ever traded in this area. In this particular case, the way I set it is according to the screen. So based on all these candlesticks, here is where the highest volume has been traded. Generally what that means is, let's say we look at this one, the next volume shelf we call it. If we were to correct and come back, here is where I would be looking at for the bounce, more higher chance of a bounce. And then you go back to look at the charts. Does it line up with anything? We can see that this was a resistance, support, and previous high. So it makes complete sense that if we were to come back, here would be somewhere that is highly likely to bounce from. Alright, so those are the indicators and tools that I wanted to go through on our first video. Again, this is a crash course, so just the ones that have worked for me, hopefully they will work for you. Try them out. The only way that you know is from trial and error. And again, you look at this, I've gone through no less than 20 indicators. If I were to give you a pointer on what works the best, is trading with a trend. You see, doesn't matter what time frame you're looking at. Let's say you're looking at the 8 hour or the 4 hour. Okay, keep in mind, if you're looking at the 4 hours, your trade should be roughly 4 hour based, meaning you should be looking at I don't know how big of a balance or how big of a correction you're looking for. It should be in the multiples of 4 hours. If you're looking at dailies, it should be in the multiple of days, meaning you just entered this trade today, you're looking at 5 to 10 days out at least. If you just enter this trade based off a 4 hour chart, you're looking at 20 hour to 30 hour kind of a thing. Trade with a trend, that's how the money's made. Okay, right now we are still in the uptrend on the S&P general market, so you want to be trading both until a sign is given. Let's say you entered here at the top of the trend, you come down, you are still going to make money because the trend is still bull. Whereas if you were trading downwards and you enter at say middle, that we won't even say the top, let's say the middle, you're going to be losing money. Trade with a trend and mind your sizing. If you're trading counter trend, size down. If you are feeling euphoria, you are in the greed mode where you want to make more money, make sure you size down. Go against what you're feeling. If you have been losing money already, size down. Don't revenge trade. That's just gonna end up causing you to lose more money. And last but not least, the most important is manage those emotions. You don't ever want to be trading based off of hope. You enter something right in the middle here. I hope it's gonna go up. And it does for the next 2 days. Then you most likely gonna be feeling the greed part of the emotions, and you're thinking, okay, it's gonna go up. We're in the great trend, increasing bull volume. We're going to break up to a higher high. Then it reverses on you, and because you enter in the middle, your risk to reward is not that great. You'll be losing money very fast. And on the reverse side of that, you enter a trade while a market is going up and based on fear, then let's say that you sold a trade over here, same idea. You sold a trade in the middle of a trend, fearing that you might lose money, and it keeps going up, then that leads to regret. So you don't want any of those emotions or any other emotions to affect you while you're trading, because when you trade and the emotions get to you, they're going to affect your trades. They're going to make you lose money. The reason why algorithms work so well is because they're emotionless. Control those emotions. Use the tools that work for you. Use the indicators that work for you. That's the best way to make money. And this is the next one is just something for beginner traders or those who are just looking to get in. Maybe use some paper trading account, but make sure you use sticky notes, whether it's actual sticky notes or whether it's on the computer sticky notes. What do you write down? A couple of things. First, your rules. Set some ground rules. So when I first started trading, one of the things I wrote down was, if I had 3 losses in a row, I'm done for the day. It sounds like gambling. Essentially, when you're trading in the stock market, a lot of people say it is like gambling. But no, it's not. It's a educated guess. You're not throwing money in there hoping to make money. You're looking at a chart, basing it off of an educated guess where you think the chart is gonna go. Write down your ground rules, stick to them. And the second thing you want to be writing down is your game plan. When you enter a trade, there's a reason why you entered. There's a reason why you exited. Stick to your game plan. Before you enter, the game plan should be developed already. Where your entry is, where your stop loss is, and where your targets are. And those are all my key points for the first crash course for beginner traders, as well as those who are looking to start. Thank you for watching. If you haven't subscribed to my video and you like the content I'm putting out, make sure you hit that subscribe button. And I look forward to seeing you guys next time. There'll be a couple of videos coming out tomorrow, and keep an eye out for those. The topics I'm planning for tomorrow are: first one, follow my journey, what my progress through the previous 10 months as a full-time trader looks like, as well as I can't remember what the second one is now, but anyways, exciting videos to come out. Make sure you hit the subscribe. I will see you guys tomorrow. Good night, guys.